The difference between guessing a market turn and trading a confirmed trend rests entirely on the identification and execution of the pivotal point. Jesse Livermore, the greatest speculator of his era, understood that true profit was not derived from predicting the future, but from acknowledging when the market definitively chose its path. He defined the pivotal point not merely as a high or low resistance level, but as the precise moment the line of least resistance shifted decisively toward a major move. This exact strategy is designed to ensure the trader enters the path of maximum potential profit with minimum risk exposure. It requires patience and discipline, prioritizing confirmation over anticipation in every single instance of market engagement. The core concept of the pivotal point is rooted in market psychology and the mechanical actions of supply and demand. It represents the price level at which the forces of accumulation or distribution have overcome the opposing pressure, signaling the start of a sustained movement. Livermore insisted that a valid pivotal point must be preceded by an appropriate period of preparation, which is typically characterized by a natural reaction or a lengthy period of consolidation. This preparation phase is crucial because it allows the stock to cleanse itself of weak hands, shaking out impatient traders before the real advance begins. The true power of the methodology lies in waiting for this confirmation, rather than attempting to catch the absolute bottom or top of the preceding move. Before we delve deeper into the precise mechanics of execution, please take a moment to subscribe and leave a quick comment, even just a single word. This simple action greatly helps the algorithm recommend this video to more people and shows me that this kind of content truly matters and is worth creating. And please do not forget to return to the channel during challenging times, when trading becomes difficult and your confidence starts to waver. Your engagement is the essential fuel that allows us to continue providing these detailed analyses of historical trading mastery and discipline. The greatest danger inherent in this strategy is the temptation of anticipation, which Livermore repeatedly warned against as the downfall of many speculators. The pivotal point is only valid when the price is physically crossed and sustained above that critical level, marking the true shift in market control. Attempting to buy just before the breakout based on intuition or hope transforms the disciplined method into pure gambling and speculation. Waiting for the confirmation ensures that the market itself is paying for the entry, rather than the trader relying solely on a personal prediction. This mechanical adherence to the entry signal is the bedrock of preserving capital and managing emotional risk effectively. The preconditions for a valid pivotal point setup are rigorous and demand careful observation of price and time. Livermore emphasized the time factor constraint, arguing that the pivotal point is only effective if the stock has spent sufficient time consolidating near the previous high or low before the breakout attempt. Quick bounces or immediate sharp reversals rarely form the foundation for major sustained moves because they have not allowed enough time for true underlying pressure to build. The lengthy consolidation period proves that professional money is establishing a position, absorbing all the overhead supply without allowing the price to significantly decline. This extended preparation is the silent signal that the market is ready for a significant expansion phase. The price action leading up to the point must provide clear confirmation of accumulation or distribution, depending on the direction of the anticipated breakout. If the stock is preparing for an upward move, volume patterns during the consolidation should indicate professional accumulation, often characterized by low-volume dips and higher volume rallies within the tight range. Conversely, a bearish pivotal point must be preceded by signs of distribution, where professional selling is occurring into strength before the inevitable breakdown. Analyzing these subtle shifts in volume and volatility provides the necessary context to determine the sincerity of the impending breakout attempt. Without this contextual confirmation of underlying activity, the potential pivotal point is merely a random price level lacking structural integrity. A critical aspect of the setup is correctly identifying the natural reaction that precedes the pivotal point. Following a primary move, the stock will naturally undergo a reaction or correction as early buyers take profits and sellers test the market's strength. The key requirement for a valid setup is that this reaction must not breach specific critical levels that would invalidate the preceding move, thus proving the underlying trend strength remains intact. If the reaction is too deep or too rapid, it suggests that the selling pressure is not merely profit-taking, but a fundamental shift in sentiment. The pivotal point then acts as the formal declaration that the market has absorbed the reaction and is ready to continue the primary trend direction. Understanding the complex interplay of accumulation, distribution, and market structure is essential for accurately identifying the best pivotal points. For those seeking a deeper, more structural understanding of how professional money operates beneath the surface of the charts, we recommend exploring the Richard Wyckoff Trading Methods channel. This dedicated resource provides in-depth instruction on the Wyckoff methodology, including detailed analysis of accumulation and distribution cycles that perfectly complement Livermore's structural approach to market timing. Mastering these foundational concepts will greatly enhance your ability to recognize the preparatory phases that must precede a genuine pivotal point breakout. You can begin your structural analysis journey today by following the link provided in the description below. In the case of a reversal from a significant downtrend, the pivotal point must follow a clear selling climax that successfully exhausted the remaining selling pressure in the market. A selling climax is characterized by extremely high volume, wide price swings, and often a sharp reversal off the lowest prices of the move, indicating panic selling by the public absorbed by professional interests. The subsequent consolidation and formation of the pivotal point confirms that the market has transitioned from a state of panic to a state of controlled accumulation. This setup ensures the trader is entering the move only after the maximum pain has been inflicted and the underlying supply has been thoroughly neutralized. Without the exhaustion phase, any subsequent rally is likely to be a temporary bear market correction, not a sustainable reversal. The exact execution strategy centers on the concept of testing the water, which is designed to minimize risk while confirming the validity of the trade immediately. The strategy dictates that the trader must take only a small initial position immediately upon the price crossing the confirmed pivotal point level. This initial entry is explicitly defined as the test trade, and it is crucial that it represents only a fraction of the intended full position size. The small size limits the exposure should the breakout prove to be false, ensuring that the cost of testing the market is negligible. This disciplined approach prevents the trader from committing significant capital before the market has provided definitive confirmation of the move. The most vital component of the execution is the immediate stop-loss rule, which demands absolute mechanical adherence without exception. If the stock, after crossing the pivotal point, fails to move forward quickly and decisively and instead falls back below the point, the initial position must be closed immediately without hesitation. This rule is designed to prove that the entry was premature or that the signal was a false breakout, known as a whipsaw. The loss incurred must be minimal, affirming that the trader respected the system and avoided being trapped in a reverting market. Livermore taught that the market should respond instantly to a true pivotal point, and any delay or failure to advance is a clear signal to exit. A valid pivotal point move must demonstrate an immediate profit, which serves as the confirmation window for the entry. If the path of least resistance has truly been established, the price should surge away from the point, confirming the momentum is on the side of the trade. Hesitation, drift, or a slow grind immediately after the breakout suggests that the point was not strong enough to overcome the remaining resistance, or that the accumulation phase was incomplete. The initial test trade acts as the market's fee for entry, and if the market refuses to pay that fee by showing immediate profit, the transaction is considered invalid and must be immediately terminated. This ensures the trader is only committing capital to trades that show instant validation of the underlying thesis. Identifying false pivotal points or whipsaws is essential for capital preservation and understanding the psychology of the trap set for impatient traders. A false pivotal point is characterized by the price briefly crossing the defined level, drawing in buying interest, but then quickly reverting to the previous trading range. This action traps those who bought the breakout, forcing them to liquidate their positions at a loss as the market reverses direction. False moves often lack the conviction of volume and the immediate follow-through that characterizes a genuine shift in trend. Recognizing that the market environment is still indecisive rather than trending saves the trader from unnecessary small losses that accumulate rapidly over time. Once the initial test trade is successful and the market confirms the validity of the move, the strategy shifts entirely to leveraging the big move through disciplined pyramiding and absolute patience. The pyramiding strategy involves systematically adding to the initial small position at predetermined intervals as the price continues to advance, using the market's profits to fund the expansion of the position. This is the mechanism by which Livermore was able to build massive positions that capitalized fully on primary moves lasting months or even years. Pyramiding is the art of scaling into success, maximizing exposure only after the market has proven the trade thesis correct. The absolute, non-negotiable rule of adding only on profit is the cornerstone of responsible pyramiding. Positions are only added when the previous trades are showing a substantial profit, ensuring that the capital risk is protected by the market's money rather than the trader's personal reserves. If the stock declines to the point where the existing position is no longer profitable, all pyramiding must cease immediately, and the trader must stand pat or consider exiting. This strict adherence prevents the dangerous practice of averaging down, which exponentially increases risk in a losing position and violates the fundamental principle of cutting losses quickly. The market must demonstrate consistent strength for the pyramiding process to continue safely. Successful major moves rarely happen in a single uninterrupted burst. They often involve secondary and tertiary pivotal points, which must be recognized as opportunities to expand the position further. These subsequent pivotal points occur after minor reactions or consolidations within the larger trend, functioning as confirmation points that the primary move remains intact. They offer additional opportunities to pyramid the position, scaling up the exposure as the trend matures and gathers more momentum. Identifying these secondary points requires the same rigor as the initial entry, ensuring that each addition is based on a confirmed breakout from a defined consolidation area, rather than simply buying into strength. The ultimate goal of the pivotal point entry is not to capture a quick profit, but to catch and ride the entirety of the major trend until its fundamental conditions change. Therefore, the strategy demands extreme patience and the discipline of holding the position through minor reactions and natural volatility, ignoring the noise of daily fluctuations. The position should only be liquidated when fundamental conditions clearly invalidate the entire move, or when the market provides definite, clear reversal signals, such as a sharp selling climax or a failure swing at a new high. Prematurely exiting a position based on fear of minor pullbacks is the most common mistake that prevents traders from realizing maximum profits from major trends. In conclusion, the power of the pivotal point strategy lies entirely in the unwavering discipline over prediction that it enforces upon the speculator. This methodology is purely mechanical, eliminating the need for emotional prediction, subjective interpretation, or hoping for a favorable outcome. It is a robust system built entirely around waiting for confirmation, executing the test trade flawlessly, and then scaling in only when the market explicitly rewards that initial discipline. This mechanical framework ensures consistency and removes the destructive influence of human emotion from the trading process. The entire system, from the initial small test trade to the final liquidation, is fundamentally a capital preservation strategy designed to ensure that large losses are avoided at all costs. The low-risk entry at the confirmed pivotal point, coupled with the immediate and strict stop-loss rule, guarantees that losses are minimized when the market proves the entry wrong. By maximizing exposure only to major trends that have shown their validity through immediate profit, the trader maximizes returns while strictly protecting their core capital reserves. This disciplined approach is why Livermore was able to survive multiple market cycles and return to trade again, demonstrating that survival is the prerequisite for ultimate success. The profound lessons of Jesse Livermore, particularly his philosophy on market psychology, patience, and the disciplined execution of the pivotal point, are timeless principles for any serious trader. If you wish to immerse yourself completely in the mindset and strategies of the man who mastered the markets of the early 20th century, we highly recommend the new edition of Reminiscences of a Stock Operator. This classic work by Edwin Lefebvre offers a deep analysis of Livermore's psychology and strategic thinking, now supplemented with unique commentary and detailed breakdowns for every chapter, transforming his historical experience into practical, actionable lessons for the contemporary trading environment. Discover the complete story of Livermore's triumphs and failures, and learn how to apply his profound wisdom to your own trading by finding the link to this essential book in the description below.